Hey, hello investors, welcome to the channel. For today's video, I'm going to show you how to sell to open and how you can use sell to open option strategies in order to grow your portfolio consistently over time. Now, if you're new to option trading, you should highly consider selling to open option strategy as a way for you to get acclimated into the options world. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to be going through sell to open option strategies. I'm going to show you how to use these strategies in order to grow your portfolio. Now, the good thing about using sell to open option strategies is that you get what's known as a premium. And don't worry, we're going to get into that as well. Now, this premium with the sell to open option strategies is going to be yours to keep no matter how the trade goes. And that is why you want to use sell to open option strategies. Now, before we get into this video, I want you to do yourself two favors. Favor number one, go ahead and always do your own due diligence before investing. Now, favor number two, always make sure you have an exit strategy before getting into any option trade. That being said, let's go ahead and get down and dirty with options. For today's option video, we're going to be using one of my favorite stock, which is going to be Micron Technology. And yes, I do have this stock in my portfolio. We're going to touch on that later on in this video as well. So to get things started, we're going to go ahead and we're going to hit Trade MU options to the bottom in order for us to open up the option chain. Now, if you're new to options trading, do not worry. I'm going to try to make this as simple as I possibly can in order for you to be able to follow along with us. Now, this right here is going to be the option chain. Now, with the option chain, what it does is that it gives you enough information in order for you to make an informed decision about what option contracts you want to get into. And we're going to be going through all of this throughout the video. You're going to have your strike prices, you're going to have your break even, your delta, and you're also going to be having your ask price, your asking price. We're definitely going to highlight this throughout the video because this is what's going to allow you to grow your portfolio consistently. You also have the fair price, and to the top, we're going to be using the sell to open option strategies. Now, to get into the sell to open option strategies, you firstly, and I'm pretty sure you guessed it by now, you need to select the sell option, no pun intended. Now we're going to go ahead to call, and now we're going to choose our strike date. Now, choosing the strike date is based on a personal preference. I'm going to walk you through my criteria of why I'm going with this particular strike date. Now, we have the February 14th strike date right now, which gives us 2 days to expiration. For my personal preference, I don't have enough time. We also have the February 28th expiration, but with that one, it gives the buyer of this option 16 days to expiration, and I think that's too much for the trade to work against me. So I'm going to hit the sweet spot, and that sweet spot I find is going to be February 21st. So that's my criteria for choosing this particular strike date. Now, also remember, your strike date is also going to be dependent on other factors. Factors such as the stock you trade in, the volatility of the stock, and the amount of option premiums that you're going to be receiving. The riskier the stock is, the more I do what's known as weekly option trading. The more stable the stock is, then I go into what's known as monthly options. So now that we have sell and we have call and we have decided our strike date, now we're going to go ahead and we're going to choose our strike price. Now, the strike price I'm going to be going with is going to be, let's go up just a bit, and we're going to be going with the $96 strike price. Now, I just touched on strike price over here. That's one of the criteria here. And I'm going to walk you through why I'm going to go ahead and choose the $96 strike price. Now, the $96 strike price is going to give me an 80% chance of profitability. As you can see, chance of profitability to the top. Now, what the 80% chance of profitability tells you is that there's an 80% chance that this trade is going to work out in your favor. Now, with the $96 strike price and an 80% chance of profitability, I'm going to be paid because that's why we're going to be focusing on sell to open option strategies. Whenever you sell to open, you get a premium right away. That premium we're going to be receiving is going to be right here, is going to be 0.96. Your 0.96 is your option premium or your credit, which you're going to be receiving. Now, that 0.96 in real life is going to work out to be $96. The reason it's going to be $96 because when trading options, we deal in multiples of 100 shares. So 96 multiplied by 100 shares is going to give you $96. So this sell to open option strategy is known as a covered call. Now, with this sell to open option strategy, one of the best benefits of it is going to be the total credit that you're going to be receiving right here. This credit you receive right here is what you're going to be using in order for it to grow your portfolio consistently over time. Now we're going to go back into the strike price and your decisions that goes into choosing your strike price. Now let's say, just hypothetically, just as an example, that we decide to buy 100 shares of this stock today at 91.53. Then we could go ahead now and sell a strike price of $96. $96 is not going to be too bad, and that's going to be because of our break even right here. The break even right here is 96.97, and that tells us we could choose any strike price, $96 and above, and still come out in this trade profitable. But that is just a guideline. I will show you in just a bit that you can choose your strike price below this break even here and still come out profitable. Now that you sell to open this option contract, when expiration date arrives, if Micron trades at any price above the $96 price right here, you're going to be assigned. Now, assignment is not such a bad thing. Assignment just means that you're going to lose your 100 shares. In order for you to do this sell to open contract, you need to first own 100 shares of whatever stock you decide to trade. So with the $96 strike price, you're going to be assigned, but you're not going to be losing anything quite yet because your break even, although it's 96.97, you still could do $96 strike price. Now let's just go a bit higher up. I'm going to show you the importance of the break even. So what the break even is showing you with this sell to open contract is that in order for you to start making money, or rather not losing money, you need to choose a strike price of $97. But that is not so. When selling at the $96 strike price right here, the only thing you're going to achieve going past the $96 strike price is what's known as opportunity cost. Opportunity cost meaning that had you chosen the $97 strike price, you would have stand to gain more on your stock appreciation. Now let's jump into the stock appreciation. Maintaining this exact same example, if you were to buy 100 shares of the stock right now at a 91.6 right now, and the share price keeps fluctuating because the market is still open. So we're going to round it up to $92 per share. So come expiration date, we're going to subtract our strike price we chose, which is $96. We're going to take away the $92 here, and that's going to give us a difference of $4. Now that $4 is what's going to be known as stock appreciation. You're going to take that $4 and you're going to multiply it by 100 shares. Once again, option contracts are traded in multiples of 100. So your gain on this particular trade, if you're assigned, or if the price trades at $96 and above from expiration date, is going to be $400. So once again, it's going to be $4 multiplied by 100 shares. In addition to that $400 you're going to be making for this sell to open contract, you're also going to get to keep your premium. So in this one trade, you stand to make $500. Now that is why your sell to open options are very good in order for you to grow your portfolio. And it's very good strategy to start with if you just get into options trading. Now, let's forget about the break-even price right now, and let's go ahead. This time we're going to choose a strike price of $95. Now, the $95, obviously, we're going to be selling below our break-even, which is 96.22. This does not mean that you're going to be losing on the trade. Remember, strike price is also a personal preference. So if you were to choose the $95 strike price instead of the $96 strike price, it clearly shows here that you're going to be selling below your break even, but that is not so. That is going to be dependent on your average cost. Now, let's say you buy 100 shares of this stock right now today at $91.60, then the $95 strike price is not a good price. However, if you later on go ahead and buy additional 200 shares at $85, then your average price, not your share price, is going to be a lot lower than this. It's going to be closer to $85. Hence, the $95 strike price is still going to be worked out as perfect. So although this says your break even is $96, your average cost on the stock is $85. So this does not count. Always keep that into consideration. So just as an example, I'm going to jump into my options dashboard in order to point it out to you. using that same stock. Now, obviously, I have Micron in my portfolio because I always use stocks that I actually own in my portfolio for these examples. Now, as you can see here, my average cost is $4,900. Stay to the end of the video. I'm going to show you how that's possible. And as you can see here, I have 2 contracts. Now let's go back into Robinhood. Now we're going to go ahead and jump into a second sell to open option strategy. And for that, we're going to do the complete reverse of what we did. So now we're going to be selling a put. We're going to be maintaining the same strike date, just as an example for this video. Remember, always do your own due diligence before investing. Now, with this sell to open option strategy, we're going to go ahead and choose our strike price below the current share price. Now, we're going to be going with the strike price of $89. Now, if you remember from the first sell to open option strategy I just showed you, the strike price, once again, is a personal preference. So with this option strategy now, we do not need to own 100 shares. All we need to do is have enough cash in our account in order for the trade to be executed. In this case, the amount of cash we're going to need in our account is going to be whatever the strike price is multiplied by 100. Once again, each option contract is multiplied by 100. So the amount of cash you're going to need in your portfolio is going to be $8,900. Don't worry about this for right now. On this channel, we specialize on growing small account portfolio. So I'm going to show you how to afford a stock like this if you have an account portfolio much smaller than this. Do not worry. So now we're going to go ahead and choose our strike price. The strike price is going to be $1.29, which is going to be equal to $129. Once again, a second sell to open option strategy where you receive a premium right away. That premium is going to be yours to keep no matter how this trade goes. This second sell to open option strategy is going to be known as the cash secured put. The one we just touched on earlier was the covered call. They are both sell to open option strategies, and the way they help your portfolio grow is because as soon as you were to do them, you're going to be receiving premium. That premium stays in your portfolio in order to grow your portfolio over time consistently and safely. Now, it would be negligent of me if I did not mention one of the most important criteria in order to do sell to open, and that's going to be your stock selection. You always need to choose the correct stock. And by choosing the correct stock, I mean do your own diligence, use something blue chip so there isn't huge fluctuations in price. This particular option strategy is known as a bullish option strategy. The reason why it's bullish is that you're of the mindset that this share price is going to continue to go up, but it's not going to hit your strike price. So if that's the case, then what is the point of choosing this option strategy? Well, this option strategy is to be used if you like the stock that you trade in, number one, so Micron, but you think that somehow you would benefit if you were to get the stock at a cheaper price than what it's trading at currently. So you're thinking Micron is a perfect stock for your portfolio. However, you prefer to get it in your portfolio at the $89 strike price. So now you're waiting for the strike price to go down to $89. Why not make a little extra money? And that's why you sell to open and you receive this kind of premium right here, which also helps grow your portfolio. Now, upon expiration date of this sell to open contract, there's a couple ways this trade could go. One way this trade could go is that if at expiration, the share price is trading at any price above that $89 here and upwards, then you get to keep your cash you leave as collateral. Remember, we mentioned at $8,900, and then you get to do the same option strategy over and over again until you're assigned. Now, this option strategy is known as a win-win option strategy. The other way you win with this option strategy is if it decides to go against you. Now, by going against you, I mean that come expiration date, if the share price is trading at any price below the $89 strike price right here, then now you're going to be forced to buy 100 shares. Now, you're asking yourself, why is that a win? Well, it is a win because remember, you did your own due diligence and you decided Micron is a stock you don't mind owning in your portfolio. So now you're going to have 100 shares of Micron. And before you got assigned, you did several cash secured puts on this and you generated lots of income. So there you go. 2 sell to open option strategy. Now I'm going to go ahead and show you my favorite sell to open option strategy. And for that, not surprisingly, we have to buy first. So what we're going to do, we're going to use the exact same stock which is Micron, we're going to go to buy and put. Now, on this channel, we hardly buy, but in this case, it's necessary in order for us to do a sell to open. So we're going to go ahead now and choose our strike date. For this instance, we're going to need to choose our strike date way out, preferably further out than 6 months. Let's just go with June 18, 2026 for now. No need to go out that far. Anything above 6 months is perfectly fine. For my personal preference, I like to choose these strike prices, these buy open. I like to choose them at a year and above. So now we're going to go ahead and we're just going to choose any random strike price, just as an example. We're going to use the $85 strike. And for that, now we have to pay 15.15, which is going to equal to $1,515. Now, I did show you I do have 2 contracts in my portfolio at which I got an average cost of around $4,000. If you were to pick up 2 contracts right now at this particular date, it would cost you way less than what I got it for. It's going to cost you around $3,000. So why would you want to do this in order to sell to open option contracts? The reason why you want to do this is, most importantly, if you trade a small account portfolio and there's a stock that you like but you cannot afford it, then you use this option strategy in order to be able to control 100 shares. Remember, this option strategy does not allow you to own 100 shares. However, it does allow you to control 100 shares of the stock. Now, the reason why I love this particular sell to open option strategy is because of the low cost to enter this kind of trade, as opposed to paying $9,155 to own 100 shares. Now we only paying a fraction of that cost to control 100 shares. So thanks for watching. Like the video, subscribe to the channel. If there's anyone out there you think can benefit from this video, feel free to share it with them. And until the next video, keep pushing your investments.